Welcome back to the channel, guys. Here today to talk about 100 baggers, 10 baggers, companies to go up. That's right. If you want to get rich, listen to me. Okay, very quickly, if you click the link below, you can get a free stock on stake. I wish I knew about stake sooner because I would have bought Tesla at 600, but thanks to Comsec not being as good as stake, I didn't. So sign up for a free share on stake with the link below. And now we're going to get into the video. I hope you enjoy it and click the like button twice. Okay, here I am coming to you from my 30 gig of RAM MacBook 2018. What you got, boy? Okay, so we're going to look at 100 baggers today by Christopher Mayer. But we're also going to look at Peter Lynch. That's right, because they're both smart people, both good investors. So we're going to start with a clip from Peter Lynch, because if you want to get good at investing, if you want to invest, listen to Peter on this point, because it's very important. And then after this point, we're going to talk about takeaways from the book 100 Baggers, which is in the link below. And then we'll go back to Peter for more. And then I'm going to name a few companies I think might be 100 baggers. Over to you, Peter.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. This is a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point, data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports. They buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we were being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated.
Okay, here's an example of a 100 bagger. Monster Beverage Corporation. I actually stopped drinking energy drinks because I was getting sick a lot, and once I stopped getting sick, but Anyway, people are still drinking Monster apparently. And look at that. It's gone from like 8 cents, 9 cents, whenever that was, '01, all the way up to $83 today.
Wow.
Okay, so point number 1 from the book 100 Baggers is buy puppies. So the book states 1 billion or less is the magic number. So obviously you can't buy Microsoft at $1.8 trillion and expect it to go 100 times, because it's going to be 5 times bigger than the US GDP. So you want to start with the company small, so it's got room to grow. So just think, this company makes battery materials. It's under $1 billion. The need for battery materials is going to go up. And this company is producing the best battery materials there is. They've got the research in place. They've got the machines for testing. They're the best they are. This is the company I'm talking about at the end of the video. And they're going to grow like no tomorrow. So remember, buy a puppy. Point number 2, quite obvious, though I will state anyway. You're looking for a company with a disruptive product, service, or business model where the company is reinvesting the earnings into the business to become more competitive / build a moat. The book states, revenue is more important than underlying earnings. As long as the revenue is growing, that's a really good thing. Underlying earnings, not as important, but it's still important, obviously. And lastly, don't pay too much for a company. So you obviously have to know how much you're paying for the company, how much they're earning, how much they will earn in the future, and think what's a decent price for them. If the price is okay to what they're going to earn in the future, then go ahead and buy them. Takeaway number 3, you want to own an operator, like Jeff Bezos, someone who's got a large stake in the company and a big interest for the company to go well in the long term.
Wow. This is really interesting.
The next point from the book, very important one, very good one. The coffee can. This comes from people used to stuff their money in a coffee can, put it on the bed in the olden days. So what does this mean in the stock market? It means once you've done your due diligence on the company, studied it inside out, see the future of the company in your mind, buy into them, and then forget about it. Don't touch the stock. You're your own worst enemy. Take a look at Monster Energy on the screen, for example. It's had big dips here of 40 to 20% sometimes, but it keeps on going up. Another example, you could see the future. Electric cars, Tesla was the leader. The most in front, the best, the greatest, had Elon Musk, but you sold out at 200. Disgraceful, embarrassing. So just so we're clear, find the company, know that they're going to do well in the future, that the revenues are going to go up and down, but mostly up. Buy into them, and then don't touch them. Ever. Okay, so now I'm going to leave you with Peter Lynch. Listen to these, let them sink in, and then I'm just going to put the company that I was thinking about for a good, maybe 10 bagger. It's already gone up quite a bit. It would have been better to buy last year. But I'll put that there, and then I'm going to do another video on that, explaining the sums, why they're so good, why I'm investing, why I'm already invested in them, why I'm going to put more money into them. Anyway, back to you, Peter.
So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be very, people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. Easy to remember, Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. You need an edge to make money, too. People have incredible edges, and they throw them away. I'll give you a quick example of SmithKline. This is a stock that had Tagamet. Now, you didn't have to buy SmithKline when Tagamet was doing clinical trials. You didn't have to buy SmithKline when Tagamet was talked about in the New England Journal of Medicine or the British version, Lancet. You could have bought SmithKline when Tagamet first came out, a year after it came out. Let's say your spouse, your mother, your father, you were a nurse, you were a druggist, you're writing all these prescriptions. Tagamet was doing an amazing job of curing ulcers, and it was a wonderful pill for the company because if you just stopped taking it, the ulcer came back. See, it would have been a crummy product if you took it for $1 and it went away, but it was a great product for the company. But you could have bought it 2 years after the product was on the market and made 5 or 6 times your money. I mean, all the druggists, all the nurses, all the people, millions of people saw this product. And they're out buying oil companies, or drilling rigs, It happens. And then 3 years later or 4 years later, Glaxo, even a bigger company, it's a huge company, a British company, brought out Zantac, which was a better, at that time, an improved product. And you could have seen that take market share, do well. You could have bought Glaxo and triple your money. So you only need a few stocks in your lifetime. They're in your industry.
Wow, this is really interesting.
Okay, so the company is Novonix. I'm going to make another video soon on why this is a 10-bagger, multiple stock. But in the meantime, you can go watch plenty of other videos out there. I suggest the 2020 webinar, that is the best one. And then you'll see for yourself why this ticks all the 10 to 100 bagger points. And lastly, click subscribe, click like, and leave your thoughts in the comments on what I need to do better. And I'll see you in the next video.
In Australia.